Now we will be going over chapter 4 from our textbook, like we said at the end of the previous chapter. So what we will do is we will try to evaluate the performance of a firm by looking at financial ratios. All right, so let's start. So the purpose of financial analysis, oh, sorry for that, it didn't crop properly. Um, is to make two types of comparisons. First, we would like to see if there's any deficiencies within the firm by comparing our firm to itself in the previous year. So by looking at the changes for year after year, we can see what type of deficiency areas there are and what type of corrective action the company needs to take accordingly. We can also use financial ratios to evaluate employee performance, compare financial performance of different divisions within the firm as well. Um, so those financial ratios can be prepared at the firm level, but also at the divisional level, and that enables us for such a thing. Like we said, when we look at the financial ratios within the firm, the goal is to compare the firm with itself, but also we can use that to compare the firm with other firms' competitors to see where we are standing, basically. And this will be the approach that we will take in our presentation in this chapter. We can look at the financial ratios from outside the firm as well. When I say outside, what we mean is how do outsiders can use those financial ratios, especially like, for instance, banks, which provide monies, funds to those companies. They want to see the most recent 2-3 years financial statements so that they can decide whether they want to extend the loan or if they want to approve a new loan application and things of that nature. Also, credit rating agencies, they constantly look at those financial ratios. Investors, before they invest in a given firm, they want to see those financial ratios as well. So how do we measure those key financial relationships? There are some certain questions we want to address. First type of financial ratios would be related to liquidity ratios, and we want to see how liquid our firm is, basically the assets that the firm is holding is. And there are various formulas, measurement tools for that. I would like to introduce a few of them. Well, obviously liquidity will be very important simply because it will tell us how how well we will be able to pay those current liabilities, right, which are coming due soon. The payments are due in the next few weeks or months, and do we have enough cash to cover those payments? So liquidity is measured by various approaches. One idea is to compare current assets with current liabilities. That will be the net working capital approach. Or alternatively, we can look at the firm's ability to convert accounts receivables and inventory into cash in a timely basis as well. So here they are. So we can compare a firm's current assets with current liabilities either by looking at what's called as the current ratio, the ratio of current assets to current liabilities, and we would like that ratio to be greater than 1. An alternative method would be acid test ratio, which is something very similar to current ratio, except that we don't include inventories in the numerator. And for our particular company, Home Depot, by just looking at the income statement and the balance sheet, we should be able to derive that information by just looking at individual numbers here. So that was the income statement, and this is the balance sheet of our firm. Let's just do an example. For instance, let's have a look at the current ratio for our company. As we said, it's just current assets divided by current liabilities. All I need is going back to the balance sheet, identify what current assets are. Here they are, 13,479 millions. So I don't need to worry about the millions because they will, when I take the ratio, they will cancel each other out with the numerator and denominator both having millions. So we have current assets of 13,479 and current liabilities of 21,236. So therefore, the ratio will give us 13,479 divided by I must have looked at wrong. So let me go back to current liabilities. I looked at total liabilities, my bad. Current liabilities were 10,122. So when you divide it by that number, it gives you that 1.33. That number is greater than 1, which is good, which tells us that current assets exceed current liabilities. We can look at also comparing firms with each other. We can also calculate the same figure for Lowe's, which is a competitor of Home Depot, and when we do so, we realize that Lowe's has a current ratio of 1.40, which is a little bit better than our current ratio of 1.33. So we just need to make note of that. Just those two numbers by themselves will not give us the full picture. We need to make the calculation of all the different financial ratios. And even for liquidity purposes, there are so many different methods that we can make the calculation. So ultimately, we will make a decision whether our company does better from Lowe's or some other companies, and based on this overall look into the picture. We can also look at the asset test ratio and quickly calculate the asset test ratio for Home Depot simply by removing inventories from the numerator. The denominator didn't change. The new figure is 0.16. When we look at the same figure for Lowe's, we realize that it is more liquid than Lowe's, because Lowe's does not even have that. I think Lowe's has only 4 cents, which is pretty good for us. So in terms of the current ratio, Lowe's is doing better than Home Depot, but in terms of the quick test ratio, Home Depot is doing better than Lowe's. There are some other methods. Like we said, a second perspective is to look at the ability of the firm to convert accounts receivable and inventory into cash by just looking at the time it takes to collect cash, basically, right? Average collection period, as well as inventory turnover. So we can easily look into those as well. Days in receivables is one such measure. Accounts receivable divided by daily credit sales, and that ratio is 19 days for Home Depot. It turns out that Lowe's is 16 days, which is a little bit better than Home Depot, which means Home Depot is taking a longer time to convert account receivables into cash. And in a similar way, we can look at the inventory turnover. How many days does it take our inventories to convert into the desired outcome, right? So how long is the inventory held before being sold? Inventory divided by daily cost of goods sold will do that, and by just looking at the income statement and balance sheet, just like we did earlier, we can look at that. And so in a sense, it takes the company 86 days, Home Depot, 86 days to prepare the items for sale. And then it will take another maybe 10-20 days until it sells it and it collects cash. So the whole thing is like a 3-4 months period until it can successfully collect the cash. That number is worse for Lowe's. It's 96 days. All right. By the way, I want to make a note here. I should have probably done it at the beginning of each of my presentations. You should not take this for an investment advice. So, right, so all of these are, even though the numbers we are analyzing are correct numbers, real numbers, they are from 10 years ago, almost 9 years ago, 2011 figures. So they will not reflect the true performance of the firms today. But even if I was looking at the true numbers, all of I'm doing is educating you guys in finance, and none of this should be taken as investment advice. All right, so far looking at the liquidity ratio component, we can compare the firms, and in terms of liquidity, so which one is doing better, which one is worse? In terms of current ratio, Lowe's is doing better. In terms of quick ratio, the Home Depot is doing better. In terms of average collection period, Lowe's is doing better. But in terms of days in inventory, Home Depot is doing better. So in two of the categories, liquidity ratio categories, Home Depot is doing better. In two of them, Lowe's is doing better. Now we can go to the second important question. Are the firm's managers generating adequate operating profits from the company's assets? So the main tool for this one will be the operating return on assets, arguably the most important ratio, though we will look at 3 additional ratios: operating profit margin, total asset turnover, and fixed asset turnovers as well. So the key question we are answering is the operating profitability of the firm. Are we able to convert, are we able to use the assets properly to have them to generate profits as they are designed for, right? All right, so operating return on assets, very simple formula: operating profit divided by total assets. Let me just go all the way back to the beginning, just to give you an idea how you can find operating profit. So operating profit is part of the income statement. Here you can clearly see operating income, which is $5,803, and we need to divide it by total assets, which is in the balance sheet. Assets is 40,125, 5,800 and 40,000. There you go. So 5,800 and 40,000, and boom. So the company's profitability ratio is operating return on assets is 14.5%. Now compare this to Lowe's, which is only 10.6%. 8%. So in terms of operating return on assets, Home Depot is doing better than Lowe's. But then we realized that, oh, before I go further, let me just mention that there is a certain analysis called the DuPont analysis, advanced by the DuPont Corporation, a pharmaceutical company, I believe, or a chemical company. It's possible to split that ratio into further. So it turns out because operating return on assets is equal to operating profit divided by total sales, we can further split them in the following way. Here, clearly notice that sales would cancel, and we are back with the operating return on assets. But this first part is just the operating profit margin, and the second part is the total asset turnover. So one thing that this benefits is the following. For instance, Lowe's, comparing itself with Home Depot, the managers in Lowe's might think, what's wrong with our operations? Why our operations are not generating as much return as the operations, every single dollar of asset that Home Depot is able to convert into profit, right? Then what we can do is, by looking at these subsections, we can further make some calculations and further compare it with the numbers provided by Home Depot, and based on those we can pinpoint where the problem is. So for instance, in the case of Home Depot, the operating profit margin is 8.5%. For Lowe's, it's only 7.3%. So that's a problem area, right? So it tells us that sales the operating profit margin is lower. So every dollar of sales is not converting enough into operating profit. So that tells us that our operating expenses and our cost of goods sold might be higher than they are compared to the figures for Home Depot, right? We might have to talk with our vendors to try to reduce the numbers, or see what are our operating expenses and see if we can improve on those numbers. And similarly, total asset turnover, when we compare them, for Home Depot it's 1.69 times versus for Lowe's only 1.45 times. Again, a problem area. This time sales divided by total assets. So it tells us that total assets are not converting into sales as much as they should compared to Home Depot. If we want to compete and beat Home Depot, we need to improve on our sales. So either by somehow training our sales force or some other means of improving our sales base given on any given dollar of assets that we have. So the DuPont analysis is very important in terms of pinpointing what are the deficiencies within the firm and how we can improve upon them. All right, so another measurement tool for measuring operating profitability in a firm would be fixed asset turnover. For Home Depot, the formula would be this. For Home Depot, when you plug in the values from the income statement and balance sheet, this is what they are. The number figure comes out as 2.71 times the fixed asset turnover, versus for Home Depot, that number is only 2.21 times. Another problem area that Lowe's needs to somehow improve upon if they want to compete better with Home Depot. Here is a table showing how you can, starting with the comparison, noticing that Lowe's is not doing as good of a job as Home Depot in terms of operating return on assets, how we can split these ratios, how we can further split these ratios to have a better grasp of individual units involved. So we need to, Lowe's is doing worse than Home Depot in terms of operating return on assets, both based on fixed assets turnover, based on inventory turnover, based on, well, no, the accounts receivable turnover is better than Home Depot, so there's no problem in this area. The problem areas are inventory turnover and fixed asset turnover, basically. So maybe we need to have a closer look at our inventory management system, right? So maybe we need to improve on the technology we use in terms of managing those inventories. All right, so this is the summary that we get by just looking into the operating return assets and its subcomponents, comparing Home Depot and Lowe's accordingly. So the third question we would like to address is, how is the firm financing its assets? And for that, we would like to look at two ratios: the debt ratio, which is ultimately the most important one that we also mentioned in the previous chapter, and the times interest earned. So the debt ratio for Home Depot is just total liabilities divided by total assets. This figure, the denominator, we already got it earlier. The total assets is just current assets plus long-term assets, which you can easily look at from the balance sheet, and that number comes out as 53%. Now compare this for Lowe's, which is only 46%. So what that means is Home Depot is more leveraged. Aha. So it has more financial risk, more business risk involved. So in a sense, Lowe's is less profitable because it's taking less risk. It seems, right? And Home Depot is more profitable but more risk. So if you are an investor considering investing in those two companies, depends on your appetite. I can imagine younger investors like in their 30s or 40s investing more in Home Depot versus more elderly investors like in their 50s or 60s investing more on Lowe's, right? That kind of makes sense. So, and that also suggests that probably there's nothing special that Home Depot does that Lowe's cannot do, right? All right, so times interest earned is yet another measure. It measures, this ratio indicates the amount of operating income available to service interest payments. And the more operating income is available, the better, right? So the higher this ratio, the better the companies. So Home Depot, that ratio is 10.9 times versus that number for Lowe's is only 9 times. So Home Depot, in that sense, in times interest earned, is doing a better job than Lowe's. And there are some notes that you guys can also have a look into. So now we can enter the summary in terms of question 3, in terms of how do we finance our operations. In terms of that ratio, Lowe's does better than Home Depot, but in terms of times interest earned, it seems Home Depot is doing a better job than Lowe's. For the fourth question, we would like to address whether the firm's managers provide a good return on the capital provided by the company's shareholders. And the key financial ratio for that will be return on equity. That's it. That's the industry standard. Return on equity is just measured by net income divided by total equity. Now, do not confuse return on assets with return on equity. Return on equity also takes into consideration the financing involved. We know already that Home Depot is highly leveraged compared to Lowe's, and as a result, we won't be surprised if return on equity will be higher for Home Depot than it is for Lowe's. And when we do the calculation, indeed, Home Depot, its return on equity is 17.7%, and it's higher than that of Lowe's, which is only 11.1%. But like I explained, one of the reasons that the ROE, return on equity, is higher for Home Depot is that it has a higher return on assets compared to Lowe's. But at the same time, the second one was that it's more leveraged than Lowe's is. So here's a graph demonstrating the relationship between return on equity, return on assets, and financing. Awesome. So this is a summary of that question, how well the company's assets, equity is turned into profits, net income ultimately. The last question we want to address is if the firm's managers are creating shareholder value for the business. All right, so are we creating shareholder value? There are various measurement tools we can use to calculate that. Both of these are industry standards, price equity ratio and the EVA, economic value added. These are standard ratios that we use. In the case of price earnings ratio, when we compare Home Depot with Lowe's, Home Depot has a price earnings ratio of 17.85 when we plug in the respective numbers. Notice here that earnings per share is derived from the balance sheet, from the bottom of the balance sheet. You should be able to find this, which is basically net income divided by the number of shares outstanding, versus the numerator is just market price per share. So both of these are per share. They are comparable. So make sure they are both per share. And then that's it. So by just comparing the figure for Home Depot comes out as 17.85 times versus the same figure for Lowe's is only 16.90 times. So Home Depot is doing slightly better than Home Depot. So you might wonder, Home Depot is has a higher return on equity, right? More profitable. How come that their price earnings ratios are so close to each other? Because it's reflected in the stock price already. Notice that the numerator stock price is a figure that comes directly from the market. Now, this is different than what we did so far. All the ratios that we had so far, all the figures in all these ratios used to come from the income statement and balance sheet. Now, for the price earnings ratio, one of the figures comes directly from the readings from the market. So whatever is the stock price at the end of the year, that's the number that we plug into the formula. And we can also look at the price book ratio, which compares the market value of a share of stock to the book value per share of the reported equity on the balance sheet. So it is, in a sense, the market value of equity divided by the book value of equity. And that ratio for Home Depot is 3.16 times, significantly higher than that of Lowe's. And the explanation would be that it would suggest that Home Depot is perceived as having better growth prospects relative to its risk position, in a sense. So the price to book ratio turns out to be a very important indicator. Why do we say better prospects relative to the risk it's taking? Because when you look at this ratio, market price divided by so market value of equity divided by book value of equity ultimately is related to what equity figure shows up in our books, in our financial statements, the balance sheet in particular, which is a historical costing approach versus the past, versus the numerator is about the market price. Well, how would investors value the equity of a firm? Well, will it be based on the past or on the future? The past was glorious and whatever, but ultimately it's the future. The past achievements has no bearing on the market price, right? Market price ultimately is about the future potential of a firm. So finance, in a sense, as a discipline, is a forward-looking discipline compared to accounting. Accounting is more record-keeping, bookkeeping in a sense. It's looking at the financial reports related to the past, compared it to finance, which is, like I said, a forward-looking approach. We're trying to bridge the gap by ratios like this, the price book ratio and so on. A second method would be the economic value added, to address the fifth question of if we are adding shareholder value to the firm. And EVA has this very simple calculation. But before the calculation, let me read through these two bullets. Shareholder value is created if the firm earns a return on capital that is greater than the investor's required rate of return. That's very important, the first bullet. So the firm will continue to generate value for shareholders as long as the return on investment is greater than the cost of capital. Those terms we'll learn more and more during upcoming presentations. EVA attempts, the economic value added approach, attempts to measure a firm's economic profit rather than accounting profit. Economic profit, as you remember, is based on the idea of opportunity cost rather than accounting profit. EVA recognizes that the cost of equity in addition to the cost of debt, interest expenses. So as a result, operating return on assets, we subtract cost of capital and multiply by total assets, and that should give us economic value added. And that ultimately will generate wealth for shareholders, basically. And we can do these calculations for Home Depot, very easy. 14.5% was operating return on assets, subtract the 10% hypothetical cost of capital. So we just made that assumption there. And because our total assets were 40,000 million, which is 40 billion, economic value added for that given year, for 1 year period, was $1.8 billion. If you divide this number by number of shares outstanding, that should give us the shareholder wealth created per share, basically. So this is a summary of the fifth bullet item, shareholder wealth creation, and comparing Home Depot and Lowe's companies. So obviously, like any other good method, financial ratio analysis has also its limitations, and you can read through these limitations here as well. It's sometimes difficult to identify industry categories and compare it with peer companies. The published peer group or industry averages are only approximations ultimately, and besides, ultimately everything is based on reported financial statements by the firm, which each firm has different accounting practices, so there might be some issues over there as well. There might be seasonal effects and bias in the financial statements, and besides, sometimes even fraud is involved. That was why Sarbanes-Oxley Act was passed in 2002, as you remember in our previous presentation. So these are some of the key terms that we went through in this presentation, and I would like to stop my presentation with with that, without further going into what are some of the published industry standards. For instance, this is an example of financial statement data for industry, in the case of the industry of software publishers. These are so when you look at financial ratios, so these are the industry standards. So if you have a company, a software company, like Google, for instance, you can compare Google's financial ratios with the industry average using figures of this sort. Home Depot operating profits resulting from asset investments. These are also some additional figures that I wanted to share as they relate to what we presented earlier. For instance, we know that we are holding a $40 billion worth of assets in Home Depot, and some of it is financed by debt, some of it financed by equity. There's a production going on which generates operating profits ultimately, right? Awesome. So hope that was useful, and in the next chapter, chapter 5, we will continue into time value of money calculations, ultimately more hardcore finance topics. See you then.